KV, welcome to the 314 Summit. Good to have you here.
Thank you.
You are a legend in the financial services area of India. Now, you were born in Mangalore a pretty long time ago. And what was your life as a student at NIT, Surathkal? What was your life in college? What was South Kendra district and Karnataka, India at that point of time?
You know, Mangalore and South Canara had only one industry when I was growing up, and that was the roofing tile business, ceramic tiles made out of clay. There's nothing else really in this. So you're very clear that you got into that sort of a business or you went out. Growing up, my family had a small roofing tile company, and this is from starting with my first year in engineering, again going back long, 1964. I looked after that factory. So my first experience in running a very small scale industry started then. And that stood me good later on, because the choice when I completed engineering was to go look after that business or go out and get another degree. So I thought to myself, I'll go out and get another degree and come back. But that never happened, because in business school, I was more interested in financial subjects.
But why go to a business school? What made you go to a business school?
You know, somehow my third or fourth year, I read about this, and I said that this probably will add a layer to my knowledge base. I had no intention of leaving Mangalore till I went to then probably in my second year when placement started. I had not applied. One of my professors said that I want to send your resume to ICICI, Professor of Finance, Professor B.G. Shah, and he sent the resume to ICICI. And then I went for an interview and I liked the place. And then I switched, rather than going back to industry, I switched to actually getting into the lending business, the development banking business.
But you are a Konkani, and they say that banking is in your blood. So did you wander into banking because it was part of the place where you came from, where you admired bankers?
No, I think it was more serendipitous. It just happened. And I loved the subject, that I must say. Actually, I must say this, that I did well in finance subjects in particular, and better than most other kids. So I knew that this is something that I could do well. So that probably gave me courage to get into this line.
And how was ICICI those days? Term lending institution, giving out loans to build industry?
If I look at it, very highly professional institution. I never imagined that an institution would be that professional. So we had people like H.T. Parekh, founder of, I would say, almost everything in finance, as our chairman. And he was our chairman for a good 4 or 5 years. And then we had, later on who became chairman, Mr. Narkan, who was my direct boss. The mentoring that I got there, I don't think I ever got anywhere else. Maybe I have mentored people, but not of that order. I could teach you every single thing, and diligence and effort came from there.
And you went to ADB after that, the Asian Development Bank.
Yeah,
I mean, what happened? How did you
actually,
go there?
Again, a bit serendipitous. In ICICI, in a way, my first brush with technology came in ICICI. And that's an interesting thing, because that maybe set the tone, as it were, for a lot of things that have happened. And I'll spend 30 seconds on that. So this is around 1980, and my boss, the legendary Mr. Nadkarni, so he calls me one day and says, I was his executive assistant. So he says, you go to London. I said, I go to London for what? I'm arranging with the merchant bank there who has a leasing portfolio. You work with them for 6 months and come back. Pick up learning and come back. So I did that. So I went there. I figured out, in those days, you can imagine technology of those days, they were running, say, lease quotations and things like that, admin all on a computer. So when I came back, I told him that I need a computer to start this business in India. So he was a little averse, but I insisted that I needed a computer, and he agreed. So we put the first 8-bit or 16-bit machine on the desktop, and started running it using SuperCalc and whatever was the database available there on those floppy disks. And just 2 or 3 of us. So we were all technology people. So I joke that when people tell me DevOps, yeah, we were DevOps. We were the developer and we were the operating people. We had nobody else. Yes. The technology people, we had nobody in ICICI as technology. So we were the developers and the operators. And we not only kept accounts on that, we built on that, we recovered on that, we ran our quotations on that. So everything was done on that simple machine with floppy disks.
And your engineering background did help?
Engineering background did not really help because we were then in a finance mode. My two other colleagues were, well, one was an engineer, one was a chartered accountant. So the chartered accountant, I said, you are the chief accountant of that business. Because we ran it as a standalone division with a separate bank account. So you learned a whole lot of things. But I'm stressing it, what sort of a leader you had who coached you. He agreed to let you on your own. He agreed to run it as almost a company. We called it a self-standing division. And that started the technology journey later on. Putting technology in ICICI in the mid-80s. It took a little time and progressing it that way. You were talking about Asian Development Bank.
Yes.
Asian Development Bank, in a way happened. That was under the next chairman that I worked for, again, the legendary Mr. Wagul. So one day, out of the blue, I got a call from somebody in Asian Development Banks. So we need a leasing specialist in ADB. Will you consider it? I really don't know. So I went and talked to Mr. Mr. Wagul. He says, let's wait. So, and I didn't think, for a moment. This was maybe 87, this was maybe in the 87 or and 88 he asked me, what has happened to your ADB thing? I said, I have not proceeded. He says, I think you should proceed, go for 2 years, you will get some experience and you'll build a nest egg and you come back and so we'll keep a lion on the job. So I said, okay, I keep a lion on the job, I go. And after 2 years, he rang me up and said, looking at various things, I think you should continue in Asian Development Bank. This was around 1990. So again, I didn't question him. I said, I'll continue there. I was getting exposed to China. So my first initial projects were in China in the ADB. And so I am one of the few people that has seen China circa 1988. When I can say that any benchmark that you used, probably we were ahead of China at that time. And then I continued to work on China and Southeast Asia and saw how development took place, transformation took place and so on. So that was a huge learning experience in terms of how countries transform. So the Southeast Asian countries were an example. The tiger countries had already grown, but Southeast Asia was a live example and we were working on that environment.
And you came back to India and...
so that also, third time I'll use the word serendipitous. I had no idea to come back. I had an idea to come back in 95, 96, but not to work. So my wife and I decided that I'm going to stop working. So a question, stop working. What will you do? I said, I still want to learn. So I said, what do you want to learn? I said, well, I'm an engineer, I have an MBA and all those things, but I have no knowledge of the real world. I have no knowledge or exposure to liberal arts. So I want to go to school and do liberal arts. So anyway, she was supportive. But so actually I put in my papers, I had actually resigned. And then somebody in Indonesia said, you please help us out for a year. And I said, okay, 1 year, but then I'm going back. And one day I got a call from Mr. Wagul, can you meet me in Singapore? Well, and then the course changed again. He said, I'm retiring next year, will you come in and take over as CEO? As straight as that.
As straight as that?
As straight as that. We met in, I remember the hotel, it was the Mandarin Oriental in Singapore. And he, as straight as that, told me, will you come? I said, fine. He says, you join the board, he must have talked to the board already. He says, join the board that was, I think, May, the July board meeting. You attend the board meeting for 1 year as an independent director, and then you come on board. So no questions asked those days, where is my contract, what is my contract, and so on. So you joined, and then it was a great learning experience.
And when you came back to ICICI, you were in the midst of a transformation, then you made ICICI into a bank. What made ICICI change its nature of lending, nature of business, to become a bank?
Yeah, I'll tell you a small story, 30 seconds before I go in there. So I come back and then one of the last things I did before I went out was basically, in a way, in those days we used to use the word computerization. So we had computerized all operations of ICICI. So all MIS, everything, and everybody was on a machine, Word was put in. By then I think, Excel had not come in, probably Lotus, something was there. So all those things had been put in. So, but to me, the database system that we had put in was the real pinnacle. So I come back in 96, and the first thing I ask is, come on, log it on for me, and I want to see it. And I see an old DOS screen coming up. I said, which world are we in? And I had never dealt with this. I said, does Oracle have a graphic interface or not? He says, yes. Then why have we not put it? So that started the technology transformation. And then, of course, the retail thing was, there was no choice. What had happened is the development bank, there were three of us. We used to actually issue bonds in the market, which banks would subscribe, and they were government guaranteed bonds. So they were SLR securities. So that was withdrawn in the early 90s. So we had no access to funding. So I said, now we need to access funding. To access funding, you need to create a brand. So that's how we created this ICICI. Prior to that, our name was the Industrial Credit and Investment Corporation of India Limited. So somebody was a branding expert. When I talked to him, he said, well, that name is like a paragraph. And I said, how about ICICI? He said, ICICI also doesn't work. It's like a sentence. I said, maybe I will take a middle path and live with the sentence. Maybe paragraph, you're right. But anyway, so that's how the rebranding was done. And then we started issuing bonds. We were the first one to do it. But then I said, what do we do for survival? So we said, and this is where again my experience in Southeast Asia, I found that at say 750 per capita income, people's aspirations changed. They wanted a home, they wanted things to put in the home, they wanted some transportation equipment and so on and so forth. I said, we will get there by 2000, 2002, at least 500 to 700, somewhere there. And we need to prepare now. So that's what pushed us into retail. Nobody believed me. Nobody believed me. The only retail player was HDFC lending home loans. And there were one or two foreign banks just doing some small amount of number of credit cards. Nobody else. So we took the leap that India will transform. And if India transforms, we have a future. And in any case, we have nothing to lose because we have nothing else to do. So we said we will take a leap and go in. And there's another thing that happened there. Key thing that happened there, Infosys. Because the technology platform at that point of time to run this sort of a thing was with Infosys. I said, that's what we will go. And it was a very simple decision. We could not afford a mainframe. So we had no choice. So I said very bluntly to my team that a mainframe is not in our life. So we will have to work with something else which is completely different. And it so happened that your software was available. And Sun had those Sun Microsystems, which again then got taken over by Oracle and merged. They had some boxes. We could run things on that. And that's how the journey started in terms of what we did. And I would think the entire foundation was built on what was available from Infosys.
But KV, you are the first Indian banker that I know who thought of technology as a core to a bank or a financial institution, invested heavily in technology. Now, what made you do it? Your experience overseas, or your intuition,
No, that was not experience overseas. All these things about product came from experience overseas. This is the future. And there was nothing to see where somebody had used technology. Here it was a very simple fact. It was that there was a giant respected bank out there, State Bank of India. In those days, I think 10,000 branches. And we had 200 branches. And the Reserve Bank was giving us approvals for 50 branches in a year. So I told the team, how many years will this take for us to get the number of branches State Bank has got? So the arithmetic was very simple. 50 branches a year into what? 200 years to get to 10,000 branches. And there was no sign of easing it at that point in time. So I said, we now need to do another technology jump. Let's put ATMs. And my colleague said, in the bank said, nobody will use an ATM. So how many ATMs were around? There are only about 100 ATMs in the country. So we said, we'll go the ATM way. 1,000 ATMs in year one. And lease lines not reliable, dial-up of course doesn't work. So we had to put a VSAT on the ATM and put it in. And the launch customer for an offsite ATM was again Infosys. And what gave us heart was there's again a Murthy story here. Mr. Murthy used to be on our board those days. So one day we were discussing in the board the ATM rollout, and Mr. Murthy said, I want to tell you something. And Murthy has got this very apt, so he says, and this ATM was put right in the admin building, if you remember. He says, I was standing in line to withdraw money from the ATM, which 100% you can believe Mr. Murthy will do. And he says, in front of me was my janitor. So you will know the name, I won't tell the name. It was my janitor. So I asked him in Kannada, how is...
He is called Chandrappa.
Chandrappa, always Chandrappa's, there will be always Chandrappa's stories. And I have learned a lot from how he has dealt with Chandrappa. So anyway, so here he tells, I asked Chandrappa, how is this machine? So he says, first class, sir, in Kannada. So he said, Murthy said, what do you mean first class? He said, sir, now, this is a machine. There are 5 people there, then I am there, then you are there. Now imagine, instead of the machine, this is a branch where there is a counter, and there is a counter clerk there, and the same number of people are there. What do you expect the counter clerk to do? He'll be jumping over the counter and calling Mr. Murthy, sir, sir, come here. And then the manager will come and there will be a sort of organized chaos to serve Mr. Murthy. But here the machine is treating you and me the same. See, that to me was one of my biggest learnings. That when you bring in technology, you are disintermediating the noise that come from this sort of what I call physical personalization. And that gave me the courage that we will now launch the next 1,000 and so on. But anyway, the Reserve Bank was kind to us. Then they dropped those 50 restrictions. They say, you can hire any number. But then we had another challenge, which again, later on I say how you had solved in Infosys. That is, we don't have the people. We don't have the branch managers, assistant managers. We don't have the front-end staff. So I told my HR guy, there's nothing we will lose. Let us codify all our training, give it out to NIIT. NIIT then was a technology trainer. And let them train people, and we will underwrite 5,000 persons a year. 5,000 to be taken in.
And what is the staff strength then?
Then staff strength was at that time probably 5,000. But he said, next year if I'm going to put 500, by now 50 had become 500, I need 5,000 people, and I can't recruit anybody from competition, because there's no competition skilled with using a machine. So these had to be basic, that's why NIIT, they can use a machine and come in. Anyway, they produced 5,000 to 7,000. So 2-3 years we had like 100% right on them, and then we said they can go anywhere, no problem, let them go anywhere. So that was started the ecosystem. Then came the next one, where we found there was no manager, and this was the front-end stuff. We need the managers and this. And how many do you need? We need 1,000 a year. But where do we train? This is a tougher one. So one of my HR colleagues came and said, my HR head came and said that, I have negotiated with Manipal University for a program. I said, what program? He said, 1-year program. 1-year program to train a manager and a deputy manager with a branch on site where they'll be put through various things. Well, they won't be 100%, but they are almost ready there. I said, but where will you get 1,000 kids? He says, rural India. This is again a message to me and a learning that rural India we tend to forget. Our lens is always on urban India. So he said, rural India. I said, but in rural India, where will you get the people? He says, he actually talked back to me. He says, you are wearing blinkers. Effectively told me, because you are looking only at the urban interface. And he says, because of family, so many considerations, people then don't get on to do a degree, but then don't get on. So here we will train them and bring in. So I thought what he said had merit. So as I was going out, I said, I have 2 conditions. One, you will advertise only in the vernacular press. No English. No English admission. And the test will be given in both vernacular and if the child wants, in English. And unbelievable, we got 100,000 applicants the first year.
100,000?
100,000. This is about 2002 or so. 100,000 applicants. And we needed 1,000. And he actually came back and said, he gave a test. And he said, I gave the same level of test that I give other recruits in the bank from, urban areas and so on. So 20,000 of them have done better than the urban guys. So there was a pool, and he says, I know what is to be done. I need to run English as a class along with the... So that's how we got the talent. And that's how, the talent spread. And that's how the technology came in, because we had no choice. We had to use those ATMs, and then we had to use internet. So what sort of disruption happened? Around 2001, if you look at the banking sector, 97% of the transactions happened in the branch. By 2003 or 4, only 10% of the transactions happened in the branch. At
Only
least
10%?
In ICICI. The rest was customer service for other things, selling a loan, doing that, this and so on. So technology could disrupt at dramatic pace what was happening.
You had something called the 90-day rule, which was spoken of in hushed tones in ICICI. What is this 90-day rule?
90-day rule is a rule from the time of one proponent, one guy who has logged on that is there also. But the rule actually started, it's not original. I was in a seminar like this of garage startups in New York. Somebody was saying, I was in New York for something, said, there is a seminar, will you attend? I said, yes. And I'm the only guy in regular suit, and everybody else in jeans. So I was listening to them, and I heard the speed at which they could get product to market. So I asked one of these garage guys, maybe in a group discussion, as to what is the hurry in getting this to market so fast? He said, we are very clear that any time there is I have an idea and a startup, I want to do a startup. There are at least 50 others with the same idea. The first to market succeeds. So I said, how do you get first to market? He says, we do it in 90 days. I said, how do you build a platform in 90 days? So I won't go through it. Kids today have figured that out too, I'm sure. But he basically said that we don't start with struggling with code. We basically assemble things and we subcontract and things and so on. But the first implementation is, we had somebody done talking about broking, and I was smiling. Before I went to New York on the trip, I had just approved a project to set up an online trading platform. What is ICICI Web Trade? This is 99 or 98. And my timeline given to me was 1.5 years. I was no wiser. When I heard 90 days, I got back to office and said the timeline changed. It is now 90 days, and we already spent 15 days, so you got 75 days. But, they built it in 75 days.
75 days.
They re-engineered the whole thing, and a lot of well-known names were around in that team. In 75 days, they built it. So once they built it in 75 days, I said, now I think we can max it. Then came our listing. We followed you to the New York Stock Exchange. So New York Stock Exchange listing, I was desperate for raising money because we needed the money and domestic markets were dead. And merchant bankers said 2 years to list because your accounts have to be US GAAP compliant now and that and this. And I said, we will do it in 90 days or you are out. So who wants to be with us? Otherwise you are out. June 30th, we took the decision. And I was also paranoid, not because we needed money. I knew the dot-com crash was happening.
You knew it?
I could feel it in my nerves. I was completely nervous that opportunity is going to be lost. So then I said, who? KPMG stood up, led by Bala, who is here. And because Bala was important, because Bala was at that point of time the only US CPA in India. You may or may not know, others may or may not know. So Bala. So then how do we do this? So he said, I'll open one conference room. It's not a very big conference room. We'll put 20 beds on the floor. And that particular floor has got a kitchen, which has got a nice dining room, kitchen. And that kitchen will be open 24 hours. We'll feed you. And you guys will work there 3 shifts. And KPMG said, KPMG was game. They said, we will have our US counterpart working on the other end. So now you see how this exercise gamed the SEC. By the time we finish today evening and submitted, they start work. By tomorrow, they have got their queries. It comes to us tomorrow morning. By tomorrow evening, that is completed. So they would then apparently ask KPMG and our lawyers, how is it that you have answers for us the very next morning? So we give you queries in the evening, next morning you have query. Long and short of it, these guys made listing in 84 days. 84 days from aligning US GAAP accounts to doing the legal due diligence. No, I think the team, once you align it, magic happens. But we didn't stop there. .com bust didn't happen. I said, we have 6 months, let us list the bank also. This is the parent which listed. So we had 2 listed, NYSE listed companies. 6 months later, we took the bank. The bank listing took only 60 days, Bala? 63 days to be exact. 63 days we listed the bank.
KV, you raised $5 billion that time.
That was the next one.
That was the next one.
This
Why did you raise $5 billion?
Yeah, but that was the next one. And that was, sometimes, this was by then, this 5 billion we are in 2006 or 7. And I didn't feel that there is a crash coming. I saw there was opportunity happening in India. I didn't see Lehman coming. But there was opportunity for sure. So I said, we need to raise capital. And on that one, Bala, you were there with us then? Or yeah. Bala knows that I had no support from my team.
Yes.
They all said, we don't need the cash. 5 billion was big money, even for those days. For those days it was very big money. It's big money even for today. But I said, we need cash. You are not imagining the India of tomorrow. I'm looking at what India will be tomorrow. So we need the money, and we are going to raise whatever. So 5 billion was the ticket that we wrote, and we raised that.
Your board was okay with that? Your investors okay with that?
Board supported me.
And oversubscribed?
Oversubscribed. Yeah, we had if I remember, it was a 4 billion issue with a green shoe. So it did 5 billion finally.
And what did the bankers tell you? Because 5 billion that time was a huge amount of money for an Indian
company.
company.
Very interestingly, the bankers were quite sanguine. I think lead bankers would have been the top 4 Wall Street firms. They were quite sanguine about it. It was my team which was uncomfortable looking at this larger number. My board was comfortable. So the board was comfortable. So I think I could, take it past the board. My team had, I would say, what I call sometimes, there is going to be dilution with that sort of money coming in. And what will happen and what will investors say? I said, what you have to sell them is what you will do with the money. Don't try to get on getting this money in is immediately going to end up in a dilution. Make the case for what you will do with this money and make it credible. And then they will put the money in. That's what happened.
And it was oversubscribed, widely
yes.
successful.
Yeah. And we kept the green shoe full amount.
And you never had to raise the money even till today?
We didn't have to raise money right through, including Lehman, COVID, nothing.
Nothing?
Nothing.
And what would have happened if you not raised the money, after the crash and all that?
I don't think we would have navigated past Lehman.
Really?
See, what was happening was, by then, looking at India of the 2000, that first period, and even up to 2008-9, we had said that we will venture globally. So we had a full subsidiary in Canada, subsidiary in London. The London subsidiary had offices across Europe, all doing well, and all well capitalized. The moment Lehman happened, they said this condition, that condition, that. So we were, at one stage, we said, all right, you have problems. Capital adequacy of all our subsidiaries is going to be 40%.
40%?
40. Now you tell us which global bank is at 40%. So you should not have any concerns about us. So that capital would not have been available. We would have been struggling to survive. And domestically also, equity was never a constraint because we had raised enough for the future.
But KV, you have been an India bull ever since I think you came into ICICI, from which time we saw you as a public persona. What made you an India bull those days when bulls were very scarce in India, in the market, except in the fields? So what made you so bullish about India?
There are two things I would say. One is what is happening, or what my learnings from looking at what had happened, again, Southeast Asia, and prior to that, Japan. That experience was, China had not happened. So China was not the model that we were looking at. It was Southeast Asia and Japan. And one learning that came out from that is when change happens and growth starts happening, it sustains for a very long period of time, unless you disturb it. In our context, I think it got disturbed for a lot of variety of reasons in between. But otherwise, it's a sustained, what now is phrased as the 25-year Amrit Kal. So my idea of Amrit Kal was that it should happen from 2000 itself. So we probably got displaced by 10 or so years in that run. So that belief was there that happens. And then what drives growth? At some, it is retail which will drive growth. At some end, it is infrastructure which will drive growth. At some end, it is white-collar operations will drive growth. At some, it's manufacturing drives. So it's seen the whole paradigm. So if I look at it, what drove the 2000 momentum? How did we come out of that 1990-2000 challenge? The white-collar people don't acknowledge the IT and services industry. And I have not really seen any recorded acknowledgement of that. What you guys did. The reason being that for every job that was created in the white-collar industry, 4 to 5 other jobs were created. This is a CRISIL study from that time. So that drove the whole, and I believe that is going to, and then infrastructure is going to drive, manufacturing is going to drive, and then this is a long run. And in between, maybe did not happen to what I'd mentioned. But then, again, we are back on track.
You're back on track. Now, KV, you became chairman of Infosys at a particular point of time, but you had a very short tenure. Then you were asked to go head the new development bank. Why did you choose the job, the new development bank, when at that stage of your life, you're the most admired banker, you're the most innovative banker, you're heading a big tech company, heading a big bank, everything was there for you. Yet you choose to leave and go to China to start off a new bank for the BRIC countries. What made you do that?
Yeah, I think somebody may say it's crazy, but it was a very interesting thing. I thought it was India had got the presidency. The founding presidency came to India as part of the BRICS negotiations, and they needed somebody with experience in this to head it up. And they asked me whether I could do it. I was 67 or 68, retired at least 5 years from ICICI, of course, with Infosys as chair. And I had seen China from, as I said, 87, 88 onwards. And I had seen the transformation thereafter. So I thought it will be exciting to learn some more. So that was the principal reason. And then working with 5 countries and setting up a new institution could be a very interesting learning experience. So it didn't take me long to say that, virtually in a day, the deal was done. And the speed at which they came back and made me, actually had the appointment out was incredible, I can say. And they wanted me in 15 days to be in China. So things happened almost at that speed. And the Chinese government also worked at that speed to make it possible. So it was a great learning experience and a great experience in terms of setting up something new. And there's a very interesting learning that's come out there, Mohan. Again, I have not spoken publicly about it, that countries of the South with ratings, the credit ratings, international credit ratings, so in that lot, so we were just investment grade, BBB minus, China was maybe A minus, other countries were probably not investment grade. So you have a bunch of countries, one in just investment grade, one slightly higher, and 3 not at investment grade. They come together with the capital put in. What would a logical way, when you look at it logically, what should be the rating of this institution which is set up? So we worked on it, and we found that if we do it right, we will get a rating almost near AAA.
AAA.
So we got a rating of AA plus.
More than any country who are members.
Who were much more than. It is like 4 notches more than any the average. Not from the it's probably 6 notches higher. But if you look at A minus to AA plus, that itself is several notches up. So we found that there is something that happens when you all come together. And as members of the South, you come together and raise money. You can raise together, but you can raise money very attractively. But you need to be together. You are individually trying to raise. You will raise it at the equivalent of your rating. And what is the difference between a AA plus and a AAA? 10 basis points in
That's
pricing.
all.
That's all. So I said we are going to be lean. We will have 100 people. We will not have 3,000, 4,000 people. We will do what 4,000 people are doing in 100 people, and we will not be price uncompetitive. So I think that's what happened with the BRICS Bank.
And at that point of time, what did you see between China and India? I mean, what are the differences? And, what learning did you have between the growth trajectories of these 2 countries?
See, at that point of time, China, starting 2000, when I said 88, there was nothing. In 2000, things had started happening. But they had accumulated a whole big mess. We are now hearing about the mess. But there was a mess in 2000. And the mess was, I'll put the number, the non-performing assets in the system were 50% of GDP.
NPS were 50% of GDP.
In 2000, the year 2000. But they did a very interesting thing, and this young friend of mine, worked it out for me later on as to how, exactly what's the model. We all know it's an AMC model. How does that AMC run? It was actually moving money from here and there, or paper from here and there. No money moved. And there was the hand of the government that, we will bless this. And of course, there was asset sale and various types of sales, and it got cleaned up. That round got cleaned up actually. And thereafter, you had the next rounds, of which you're now seeing the challenge, which I don't know much about because it post me. So I saw China which had cleaned up that mess and had then gone on this massive expansion of various things. So what was most relevant for me was that our next growth phase will entirely be built on infrastructure. The white-collar revolution is already ahead of us. Infrastructure is going to be the next big push. And the support infrastructure for whether it's ports, airports, rail, telecommunication, power, and greening, all that is going to happen. Also what is clear is that we are late to the party, but it doesn't hurt. And to me, this is great learning that I had. Late to the party, but doesn't hurt. Because when I went to China, or say 5 years before that, the cost of solar power in India was what, 15 rupees?
Yes.
And of course, the installation cost was also X times higher than fossil. But when we are now looking at it, late to the party, we are getting green power at what, 3 rupees, 3.5 rupees, whereas fossil is costlier. Because green has other challenges, but so you could figure out that a lot of things now we can catch up, though we are late to the party. And there we saw, of course, the digital revolution, where none of us virtually carried any money in our pockets. And the e-economy coming up with the delivery thing starting and so on. So we knew that all this is going to happen in India. At what pace was indeterminate. But to me, post coming back, the big lesson is all it took was that one event, COVID, to accelerate the whole pace of transformation. Get UPI really to be something that everybody will say, or encourage all these new companies which have today presented here in the fintech space to get going and so on. So what I saw there in this space, we were probably, I would say 10 to 15 years behind. But in the span of 4 or 5 years, we have caught up.
You caught up, we caught up.
This area we have caught up.
And you are now chairman of NaBFID. You are now National Bank for Financing Infrastructure and Development. What will you do as chairman of NaBFID to change the face of this country? And why you? And why this institution?
So I think, again, I was there, appointed as chairman, and there's nobody else appointed. There was a charter from the government, and I was appointed as chairman by the government. But then all the usual work you guys do, I had to do. Start up my whatever, third, fourth startup, 67, this was at maybe, 74 or so. So we did that. And it's basically the initial building. But what is the purpose of NaBFID? That's the proper, that's what I should properly address. That is basically to recognize that the next wave of push for this economy I'm very bullish about is going to be infrastructure. And for some
infrastructure so late in the day?
Yeah, because
we never did it.
We lost time in between. Because particularly between 2010 and maybe 2016, because a series of things that we did, did not work out. So initially there was 2G, there were problems. Then there was problem with solar, it's not solar, fossil fuel plants, and a series of highways, there are problems and so on. And we had to then get all these things right in the last few years. And by then you find that such a big backlog that you need to accelerate it. Now if you look at it very carefully, banks are ill-equipped to fund the infrastructure, commercial banks. Because the average maturity of a deposit, average, because you have fixed deposits and current and savings deposit, is 1 year. How can you fund a project where you need 10-year money with 1 year liabilities? You are carrying a basic ALCO mismatch. So you need long-term funding. And now you have pension funds that are there in the country, life insurance in the country, and the capital market itself has grown. So you needed an institution which could now be there and in a way act as a demonstration that the capital market is the route to fund these and to channel funds for this purpose. So my view is that NaBFID is a catalytic institution to show the path that this is the route that we could take as we go along. And that will take, they're already, the first year, I think they'll end up doing probably 1 lakh crores in
1 lakh crores
in lending.
That's about $12 billion.
Yeah, but it has to be much bigger than that to meet our needs. To me, that's a catalytic action in terms of what we will do. And along with that, what has happened is there are new instruments which have come up now. For example, InvITs that have come up. That's taking shape. So funding InvITs, funding new structures is also part of encouraging the capital market is part of the mandate of NaBFID. So it is meeting both these purposes to provide the funding and provide for development of the market. And that's what's happening. It's now fully functional. And once it's functional, my role is to govern as a board chair. So the team does everything.
KV, you are on record recently to say that this year has been the best year for Indian banking for the last 50 years. And you're also talking about India's growth forward. Can you tell this audience 5 things that are happening in this country which are transformational and which is making life exciting for you and which you see happening in the next 5 years?
Yeah, I think first is foundational. When I say, I've never seen banking as good as it was. I've never in my life seen the top, say, 150, 200, 250 companies, maybe up to 500 companies, virtually unleveraged.
Unleveraged. Top 500 companies.
They have got nominal degrees of working capital or so. And they have cleared up during the COVID period. That is the beauty of it. So that is foundationally clear. As a consequence, banks which 2 years back or 3 years back were looking like large capital induction is required, and now running capital adequacy of whether you're a public sector bank or a private sector bank, running from 14 to 17%. Nowhere in the world can you see these sort of numbers. So you have a banking sector which is flush. You have a capital market which is throwing up money, and you have corporate India which is clean. And a corporate India which again is not talked of too much, able to implement projects at probably 1/3 of the time speed, at 1/3 the time taken, speed has increased, what it was in the past, say 10, 15 years back. So a new project, less than 2 years, a brownfield project, probably 9 months, except when it is a steel or a very heavy type of things. So these sort of things. It means you can have just-in-time projects for a market. This also is a thing. So another thing which is not spoken more on, which sometimes I'm a little worried that we don't say what we see. So for example, 6-7 months after COVID, COVID was 2020 in India, maybe 2021 January, I was talking to somebody who in the family has got a large number of engineering companies, auto component companies. So I asked him, hey, are your people back, and what are you producing now? In the sense, is it 80%, 90%? He says, no, Mr. Kamath, we are 100%. I said, very good. So your people have come back. He says, no, Mr. Kamath, only 75% have come back. So I said, but what happens to the balance? He says, we may or may not need them. Looks like we don't need them. But I said, how did you get this? I said, this is productivity improvement. He says, process change, some automation, this and all. This has happened. So I said, okay, something interesting is happening. Then a week later or so, we had a National Council meeting of CII. And I had been asked to speak on the economy there. And I said, well, I will speak, but I want something in return. I want to do a dipstick. Tell me, post-COVID, same question. What are you producing? What is your output now? And are your staff back? Numbers are more or less same. We are back to between 95 and 100%. And we have got maybe 75 to 80% of the staff back. And well, those are trained staff. They will be used when production increases. But for the current level, we don't want. The next quarter, if you see, and if you can see the summarized performance of corporate India that used to come in money control, there was a 25% jump in EBITDA.
25% jump in EBITDA.
So clearly the productivity gain translated to this, and that was what saved the corporates in terms of cleaning up, provided cash flow to clean up, repay banks, and they became strong and so on. So a huge foundation is created. So you have got everybody buying into now a formula that we need to work with our own cash flow. We need to only take marginal funding for anything, not rely on leverage. So that this is a young group. So I'll put what was the leverage that corporates ran at in 2000, so that you have a context. 4.7:1.
4.7:1.
4.7 debt, 1 equity. We don't talk of EBITDA thing, but we talk of debt to equity. 4.7:1. And that I said now is virtually nil.
Zero.
There is nothing. So that is what the transformation that has happened. So A. B, I think what we see here, this digital universe, this is driving. So to me, there are 2 or 3 drivers. This is one. I'll come to this in a minute. But the key is there is an unfinished infrastructure agenda. There is, I think, a growth momentum which cannot be stopped unless you do something really stupid. You completely break the system. You raise interest rates to unheard of levels. You fear the unknown and so on. But nobody is going to do that. There's a very rational way in which things are being done. So given that, we should be growing at 8.5%. See, I can tell you this, Mohan, the 8.5 number that came out for the last quarter, I was clear that that's where we are heading, though consensus number of 6.9. I said, nothing is telling me that why it should be 6.9. And now everybody is surprised why it should be 8.5, which means that we are not doing our homework properly. The system is not capturing data properly. And I'm sure they will now understand how to capture it. So second. The third or fourth big driver is going to be digital. Again, nobody has understood what digital will contribute. Now, we are now what, 8% to 9% of GDP is digital contribution from digital. Now, you look at China, 35 to 40%. We should be there in the next 2 to 3 years, as I see. And to me, that 25% or 30% incremental is not going to be in that 8.5%. It is going to be 8.5% plus that 25%. So if you do that, I'm looking at 10% growth. So my desire, my hope, my wish, and I think what is feasible is aim for a 10% growth. And it will happen. You aim for a 7% growth, you will end there. So I think that everything is ready. You have a clean balance sheet, corporate, clean balance sheet banks, capital market which is thriving, corporate profitability. For the first time, they have learned how to be efficient. And one other thing that has happened, which actually this recent, that we have now learned to do things at speed. You look at how the new parliament building was built. You look at, a lot of you would be traveling to Mumbai, how the coastal road project has been built. Coastal road project in front of my eyes started during COVID. June or July of 2020 it started. It is now operational. The one leg of it, the southbound road was opened 2 days back. It now takes you from where you exit from the sea link to reach your, if you are at downtown, any downtown hotel, the Taj or the Oberoi, it will take you 12 minutes. From the time you exit the sea link and take that highway, it's 12 minutes. So things are happening at dramatic pace. Take the Atal, Trans Harbour link, again built in about 3 years. 22 kilometers of over the sea link. I thought I will not see this sort of a thing in India, but built in 3.5 years. So we are learning to do things at speed, which will stand us in good stead as we look at the going ahead.
KV, now you have been a startup founder. You started technology in a financial institution when nobody knew technology. And then you, as a startup founder, made one of India's largest financial institutions, term lending institutions, into a bank based on technology. And then you were the chair of a technology company. You left this country and started a new financial institution in China. Now you have come back and you're the chairman of NaBFID and you're the chairman of Geo Financial Services, which I'm sure is going to give competition to many of these fintechs. Now, what is your advice to all these young entrepreneurs who are setting out on the journey, who are facing the challenges of building teams, of putting technology to work, of marketing and sales, not having done it before, doing it the first time in a hyper-competitive environment, in an environment where technology is moving so fast? What would your advice to them be to succeed in the next 3 or 4 years?
They have that last point that you made, technology. That's what they will leverage. And I'll talk about that in more detail. That's what they will leverage. That's what they will use to hammer the extant system. The system cannot change. So they will revolutionize this. But the key is they have this India opportunity with them. They know this market and they have understood nuances which no banker has understood. You're
seeing nuances which no banker has understood.
Through just 4 of the presentations or so today, I can tell you this. The nuances that they brought out, no banker has really understood. No banker understands the customer as they have done. No banker understands the way the customer has to be approached and the deal has to be done. So it has been, for a long time, used to use the word lazy banking. Lazy banking still pervades. But this is disrupting that lazy banking. This is one. Second is, for them, technology is their strong suit now. And they know how to harness it, how to master it. Whereas the incumbents, the legacies are slaves to technology. They don't know how to master it.
Say it again.
The legacy guys, the incumbents, are slaves to technology. Whereas these guys are the masters of technology. And I mean it in literal sense. Because the slave to technology still, I used to use a phrase long back, that in IT department are the high priests, and the mainframe is God. So you want to talk to mainframe, you first talk to the high priest. And then they will decide, and that's where the DevOps thing comes, because I say something, he doesn't know what I'm saying. He says something, I don't know what he's saying. And we end up making a mess, and then this one. But, so this is where I think things need to, this is where they have a huge hand. And I learnt it, well, I'm now learning it in spades after coming back to India, in China. And I'll give a story. So this young man again was with me when I went to China. And we had 4 people in the bank. This is BRICS Bank. And my HR guy was there, also from India. So one day he said that we are now started getting hundreds of applications. So we need, or thousands of applications. We need an HR system. So I said, okay. So I go on Google and I say, top 10 HR platforms. Darwin Box wasn't there at that time. This is 2015. Otherwise, it would have been Darwin Box. So out comes something called Bamboo HR. So I tell this guy, go study Bamboo HR, look at whatever is available. One day later, he comes, it looks excellent. I said, good. Pricing pucho. I'll tell you the pricing in a moment. Then I told him, send it to ICICI, the link, and let them tell me what it is. They said, it looks very good. So I said, negotiate. What did you negotiate? $5,000 and $5 per customer, something like that. $5 per employee.
$5 per
and 5,000 customers. Darwin Box should not hear this. So we said, wonderful. And we said, we are not going to have more than 200 employees. So that's what we are paying for that. Then we said, we got brave. I said, I don't want SAP in my life. So I want easy plug and play ERP module. So same question, top 10 ERP platforms, cloud-based. Pop comes up, NetSuite. So, some due diligence. Looks completely plug and play, 12 modules, 1 training module. So I send it to Vishal. I say, Vishal, what is NetSuite? He said, buy it.
Oh.
I said, but no, you are the CTO of SAP and you are telling me buy it. He says, go buy it. I said, but who are they? So he says, somebody has come out of Oracle and set this up on his own in Singapore. Larry is a small stake, but this guy runs it. And it's a complete plug and play ERP platform. Of course, now I come back here and there are Indian companies which are doing probably a better job. So they are all living in this world of new technology. But the incumbent bank or the incumbent fintech is not capable of doing it easily. They will struggle to do this because somehow the mindset is still that machine is the master and I am the slave. Whereas these guys play with that technology. And that is the difference which will make them...
so you see very rapid progress.
Yeah. And I used to have worries about one thing. But today, again, several of them used the phrase which delighted me. Absolutely delighted me. And I'm going to use it repeatedly. That is Bombay balance sheet and Bangalore balance sheet. That is fantastic. That's exactly what I used to say. That a lot of 100,000 startups are there. They have built great platforms. And there is great value in the platform. The difference or the problem is between that value in the platform and the valuation expectation that somehow has crept into that. Now, where and how I don't want to go into. And that causes challenges. So if you were to neutralize that, it's a great thing. And sometimes you don't neutralize it because hubris builds in. So I would ask myself at every turn, do I need those engineers? Do I need those? Do I need to be like a tech firm? Is it time for me to move on? Well, I have talked to digital firms and they're very proud and they say, I have 400 tech guys. I say, why do you need 400 tech guys? And then they're scratching their heads trying to figure out why they need. Because the work is over. They are done. They have to now move on. They need the other guys that in 3 other presentations I saw. You go to rural India, you go to middle India, you need the guys who interact there. The tech guys have done their job. They have to maybe just tighten some nut, loosen some nut as they go along, plug and play something, impose something and go on. And actually the work that these guys have done doesn't take, it's not too difficult for incumbents to put on. But the nice thing is that for this audience, they are not going to do it. You can take work some of the digital startups have done and actually I use the phrase, float it into a bank. In 30 days, you can actually replace the entire tech platform in a bank today. But nobody will do it.
Okay, folks, now anybody wants to ask a question? We had a fascinating conversation. We got a few minutes. Any questions that you want to ask? Come on.
Thank you.
Yeah, there is one now. No, we're not finished, KV. One more. Yes, please stand up, please.
Thank you for the insight, sir. My question is, you've charted out a wonderful path ahead for the country. What do you see as the immediate sort of risks ahead for India Inc., but particularly the startup ecosystem?
Thank you. I think the country's risks today are primarily what will come from an external shock. Though we are insulated almost to anything that I can think of, but there's always the unknown which could hit you. And two events we withstood. We withstood COVID and withstood the events in Europe. So I would think we have learned. We could have made mistakes during both events. For example, we could have, worried about interest rates, gotten interest rates up, and that sort of single mistake we would not have been talking so comfortably today. But we have a leader in the Reserve Bank, we have a leader in the center who held things steady. And through COVID, through these interest rates remained comfortable. Indian industry did well and has come out of it. So when there's an external shock, how do we react to that, or how do you manage that is to me the biggest risk. So you make a miscalculation there, you will have. Internal risks I don't see, I think, because the country is growing at a pace where I think everyone will do well. I am not a politician, so I don't listen to political noise. But I think if the country does well, then everybody is happy. So I don't see any risks internally.
Any overseas investor wants to ask a question? We have people from overseas who come here. Yeah, 1 minute. Any overseas investor? Anybody? You got an institution builder here. Good opportunity to ask any questions you might have. Yes. Yeah, here. Mike here. Then I'll ask you. Yeah.
Thank you for giving your background and for coming here to speak today. I think it was last year that it was announced that BlackRock and Jio were partnering for asset management for India investors. Can you maybe speak to some of the trends that you've seen over your years about domestic investors and what you're excited about going forward?
Thank you. I won't speak about Jio BlackRock because that I think is the CEO's job. But I can broadly say what excites India, and that should excite a lot of the players here. And they probably also, I think that there's somebody which is a large entity coming in. See, I look at India as the next big opportunity. And nobody is there who is large enough to serve this opportunity. And that is why all the presenters here, all the players that are talked of have an equal opportunity. And let me put it in context. I think we have an opportunity to serve a set of customers. I think one of the slides very correctly captured it. It said private banks handle this, public sector banks handle this. Now, if you can look at a slice of opportunity across going down to the bottom of the pyramid, the real bottom of the pyramid, I think that is something that would excite any new entrant. And that's something that would excite me, for example, that what we could do to the country. And how do you do that? To do that, because the margin there, what you'll earn there is going to be very small in amount. So you need scale. So how do you get that scale? You get that scale using technology. So technology, low-cost technology becomes the key. Now, if I go back to the banking day, early banking days with technology, I could not afford a mainframe for two reasons. One, I could not afford to put it up, install it. I could not afford to run it. The operating cost was beyond me. Because if I'm looking at bank deposits, where the average deposit is 1,000 rupees, and if I'm going to earn 1 rupee, 1% on that, or 2% on that, how am I going to afford architecture which is... So you have to learn to operate at low cost. So I would think that all of us collectively, whether it is the company that I am the chair of, will have to learn to serve this mass market at very low cost. And our profit comes from low unit profit multiplied by high unit numbers. And that will be true for every single product that would be sold in the financial services business. That has been done earlier in other areas. For example, in shampoo, maybe 20 or 25 years back, the concept of a sachet came about in India. Nowhere else in the world do you see a single-use sachet shampoo, because your potential customer could not afford a bottle of shampoo. So he could not afford in those days maybe 100 rupees for a shampoo, but he could afford a quarter rupee for a single-use sachet. So same sort of approach we need to take here. How do you get unit cost down and work with large volumes? And we do that, then we have a
Last question.
succeed, we will succeed.
Yeah, last question. Come. Yep.
Yeah. Hello. Yeah, sir, first of all, it was like very, very fascinating to hear this, your journey and the story, very inspiring. I'll ask slightly controversial question. So I think today when I see in general from a regulator side, I think the regulator perspective which I see, they still trying to, or I would say that perspective is that we should shield incumbents first, because the systematic risk can be created at large because of technology. So, like, what's your view on that?
Okay, I get the entire question. So, and this is not new because we would have gone through similar things in the past also. I would put it this way: the regulations are there equal for everybody. If I look at this regulator, particularly in the banking space, the sandbox approach that the regulator took and allowed new technologies, new things to is laudable. So that has been done, and I don't think it is discomfort with the digital players. I don't believe there is discomfort. My own reading of the Reserve Bank is there is no discomfort. But I will say, in terms of your technology and what you're doing, where is the discomfort? And I believe that discomfort that I'm going to talk about, you can easily resolve. That discomfort comes out of not following practices. And I will answer your question on protection of incumbents. That question that comes about from not following what are regulatory guidelines. And regulatory guidelines are not that difficult to follow if with your ability to use technology, you can fall and comply with regulatory guidelines. So that's all the regulator is asking you to do, follow regulatory guidelines. And the cases that have been flagged in the event, I won't name anyone, to me are all where, for whatever reason, the regulatory line got tripped. I don't want to ascribe any reasons, but it got tripped. Now, there is no case for everyone to be worrying that this could happen to you, as long as you are clear that you are doing things what is right. And for that, I have a phrase which a long time I used to say. It is always look at your dashboard. It's like you're driving a car, you look at your instruments. Make sure that you are checking things out and doing things. And the first three things that I would urge anybody in the fintech business is have three key positions filled. The first thing, not your business positions, your compliance, risk, and internal audit. Once you do that, this fear you will, and put good people, let them be rigid, and you see how within the ambit of this you run your business, and you will be able to succeed. Now, this protection for incumbents, I would think that there we, all of us collectively, including NBFCs, they're not allowing, say, for example, deposit taking. That is because regulator rightly has to look after the interest of the depositors. And it will take a little time for that confidence to come up. Now, in the meantime, we will have to navigate as to how is it that we will fund ourselves and how will we do business. I think it's a step-by-step process. It will be opened up step by step. And as it opens up, you'll also find there are other instruments in the market which you could access to fund yourself. So this play is going to be not the same a year and a half as it is today. Because today, most NBFCs would believe that my source is basically having a bank partner and selling it down. You may find a year and a half is that my source is approaching the market, and it's a transition phase that is going on. But if you expect that the regulator is going to allow deposit taking, I am a little bit skeptical about that. But it will take a long time. It will take a long time because they have to be sure that the depositors' interest is first looked after. But doing business, I don't think there's a problem. I think we need to make sure that in the way we behave, we act, and the way we do business, the regulator has comfort.
So folks, I think it's been fascinating. Please give a round of applause to KV Kamath. And thank you very much.